David, one aspect where I'm very curious about how markets and banks react is Americans have actually been making a lot of money on high rates if they have their money in money market funds, if they hold treasuries and so forth. You know, taking things down a half point doesn't change a lot, but it might just be enough. And I'm curious what your take is to kind of start moving money around and at the margin take a few dollars out of what's been a very lucrative place to park cash.
Well, I don't think it'll have that effect. I mean, I do think that it squeezes the income of older Americans just a bit. But what it does, I think it will introduce the question of, well, how much is the economy slowing? And that is not necessarily good for the equity market, no matter how much it, positively responds to what they've just done today. I mean, as I say, I think the economy is strong enough to handle this. But overall, I think the messaging is very important from here. So in the press conference, it's very important that Jay Powell stress the level of comfort with inflation. Look, we've got lower gasoline prices down 70 cents year over year. We feel good about growth, but honestly, inflation's doing even better than we thought it was. So that's why we can move today. If he stresses progress in inflation rather than worries about unemployment, then he'll do the economy a great service. And I think that'll make this a much safer cut.
Steve, Claudia made the point, I invite you to pick up on whatever thought or tangent you would like, but Claudia made the point that this is a different circumstance. We haven't had this kind of initiation of a rate-cutting cycle in a long time, certainly not under these kinds of circumstances. When we've had rate-cutting cycles before, it's been in response to economic crises like the pandemic, like the financial crisis in 2007, 2008, 2009. Here it's a different set of circumstances. Economy's pretty good. Very little sort of idea that a recession is on the horizon. Talk me through that. Talk me through that, if you wouldn't mind.
Well, Claudia studied history. That's why she's famous in our world. I've studied history maybe a little bit less, and I can tell you with experience that nothing works, Tyler, in terms of comparing this to any of the cycles. There have had a complete lack of analogs for the world we're in right now. Fundamentally, it seems like what the Fed decided is this was really a transitory supply shock, somewhat exacerbated by somewhat loose monetary policy, somewhat loose deficit spending. But if you hear the Fed talk now, much of the blame ends up being on the supply side shock that kind of worked itself out. A lot of that created a background of why the heck are we so high if it was a supply shock and it's largely worked itself out? We have another half a point, maybe a full point to go, depending upon how you want to measure it. And we can get that done by being restrictive, but we don't have to be this restrictive. What Powell took, I would say, Tyler, is 50 basis points of what could be an easy 100, 150 that the Fed can take and do so while remaining restrictive and not even be in danger of sort of further stimulating the economy. The game now is going to be restraining the market and its forward pricing of where the Fed is going, because that forward pricing, Tyler, as you know, works itself into the real economy through the floating rate mechanism that allows businesses to go out and borrow at tomorrow's yield. And that's where the stimulus comes from. So now we begin a game of the Fed on top of the horse, holding the reins and figuring out how much to let out the reins and how much to pull back. Right now, they let it out 50.
It's a great point, Steve, to emphasize, that's where a lot of this will hit the real economy. And in some ways, that move's already been made, and we'll see how markets react. And on that point, Jim Caron, I just wanted to point out, if you told me that they were going to cut 50 and asked me what I thought the stock market reaction would be, I could go either way. The reaction so far has been positive, though, and that seems to be a sign that they're taking the kind of this will be stimulative on the margin and keep the soft landing intact story, as opposed to the we're at the beginning, like Tyler was saying, of a recession, and as we've seen with past cuts of this size.
Yeah, I think the market's signaling that this is a step in the right direction for the soft landing. I want to pick up on one thing that Steve Leisman said, because I think the eye on the prize here, what we need to be focusing on is where the terminal rate is. Where they begin this journey to cutting interest rates is an interesting point to talk about today. But what the markets are going to focus on ultimately is where do they end. So the faster they start cutting today, that means they might go slower later on. In other words, they get this move done with, and we get the stimulus that the economy needs from rate cuts. And yes, that's positive for markets. Markets will view that as a very positive thing. But remember, what markets are we talking about here? So ultimately, if the Fed goes 50 basis points, goes very aggressive, cuts 100, 150 basis points, does that mean that their terminal rate, do they end at 4%? Do they end at 3.5%? Because right now the bond markets have been pricing for the Fed to cut 200, 250 basis points. If that doesn't happen, that represents a disappointment to that asset class, and that could lead to a sell-off maybe in 2025. Also, if the Fed doesn't cut this full amount that's being priced in today, does that represent a disappointment even to the equity markets at some point in time, because equities are counting on this 250 basis point rate cut as well. So what's ultimately going to matter in this thing is going to be the data. It's going to be the employment situation. And ultimately, we're going to see how inflation creeps into this as well. So look, we're at a good starting point right now. The Fed has done something very aggressive. This is friendly to risky assets. There's no question about that. But ultimately, the question we need to ask ourselves is, where does this end? And that's good. That termination value is going to determine the value of asset prices in the medium term.